in 2005 and into early 2006, I was looking at what was happening in subprime mortgages and alt-A mortgages, and I said, this is going to end really badly. This is 2005 now. And I was working at a hedge fund at the time, and just looking at the origination criteria that people were using to generate these loans and looking at sort of the early trends with people defaulting right out of the gate and things like that, I said, this is not going to go well. And the origination volumes were exploding, right? Wall Street just couldn't make enough of these bonds. They were making them as fast as they possibly could. And so I said, you know what? This is going to end badly enough that I think we need to find a way to short this market. And the credit default swap had just been invented. Okay. It had been sort of in the works for a while. And when the credit default swap came along, I said, this is how we're going to work on how we're going to exploit this idea that the subprime crisis is going to come at some point. And so we launched a fund that had sort of the big short style trade. And, long story short, it did very well. But during the time,
it didn't do well, or it did, you said?
It did very well. Yeah. It did
okay.
extremely well. And during the time that we were trying to launch this fund, and even after the first leg down in 2007 into early 2008, people were like, you're crazy. You're going to lose money. The national housing market has never declined in uniformity the way that it has to for you to be right. There were a lot of people who said you're just a doomer, you're a perma-bear, all these kinds of things, and it turned out to be right. And it turned out to be a really serious, obviously the great financial crisis destroyed a lot of wealth. It destroyed lives. It people lost their homes, they lost their jobs. It was a serious downturn in the global economy. It was exacerbated by the CDO phenomenon, which we can talk about if you like. But all of this goes to show that even when you get it right, you're going to have a lot of people who say you're wrong. It doesn't make any sense. You're just being a doom and gloom. And, we're seeing some of that right now in terms of inflation and interest rates and tariffs. So we can get into that a little later, but that was clearly, a good call, and one that, we were able to execute on and make a lot of money for our investors.
You could have been featured in the Big Short. I have the feeling that I was hearing the script of the movie, no?
Yeah, it was. I mean, there were, if you talk to people now who were in the business at that time, we're talking now almost 20 years ago, everybody will say they had that trade on. Oh, we had the short trade on. We knew subprime was going to blow up. Not true. There were a relatively small number of folks who really put the trade on in size. We were by nowhere near the biggest. You had Paulson, who had a lot of money raised in his trade. But for our investors, we were very happy with the returns we were able to produce for them.
Yeah, forget Michael Burry. You can get Dean
to make the and there were a small number of people who made an awful lot of money. And I have to say that when you were in that trade, it didn't feel good. Okay. It definitely felt, we knew that every time, the subprime index went down another 5-10 points, that meant that people were losing their homes. Okay. Mm-hmm. But your job as an asset manager is your job. And this sounds very cynical, but it's true. You're not there to save the world. Okay. We're not curing diseases. We're not curing starvation. we are there to make money for our investors and protect them from loss. And that was, at that time, that was the best way to do that, even though it didn't feel good, on a personal level, to be sort of betting against the U.S. economy.
You've reached the end of this clip, but the story's not over. To watch the full episode, follow this link. Go on. You can do it.